Singapore's economic success story is remarkable, with its gleaming skyscrapers and thriving economy symbolizing rapid development. However, beneath the success lies a hidden reality, a significant amount of government debt. In 2023, Singapore's gross government debt reached an astonishing 170% of its GDP. This figure surpasses many developed nations, including the United States at 123%, the G7 average of 128%, and Canada at 106%. Naturally, one might wonder how Singapore accumulated such a large debt and whether this should be a cause for concern. To understand this, we need to explore the factors that have contributed to Singapore's debt level, including the country's unique debt management strategies, fiscal prudence, and long-term economic planning. Typically, high government debt levels signal trouble, indicating economic instability, inflation, and financial crisis. Historical examples such as Argentina highlight the perils of excessive debt. However, Singapore's situation challenges this narrative. Its high debt-to-GDP ratio does not tell the whole story. To fully grasp the situation, it is crucial to look beyond the headline numbers and delve into details of Singapore's debt structure. The composition of a country's debt portfolio is key in assessing its risk profile. For instance, debt denominated in foreign currencies can be particularly risky during currency fluctuations, and short-term debt can create refinancing challenges as governments need to constantly roll over their debt obligations. In contrast, Singapore's debt is predominantly denominated in Singapore dollars, mitigating the risks associated with currency fluctuations. Furthermore, the average maturity of Singapore's debt is relatively long, providing ample time for repayment and reducing refinancing pressures. Moreover, a significant portion of the debt is used for strategic investments, particularly in infrastructure, which is vital for driving long-term economic growth. Singapore employs innovative strategies to manage its debt effectively, utilizing various instruments such as Singapore Government Securities and special Singapore Government Securities to fund projects. SSGS are issued mainly to develop the local debt market, fostering a vibrant bond market essential for the financial sector's growth and stability. This also helps manage the country's liquidity, controlling inflation and ensuring economic stability. SSGS, on the other hand, are non-tradable bonds issued to the Central Provident Fund, Singapore's mandatory pension fund. These bonds help manage CPF funds, ensuring the government can meet its liabilities to CPF members. Additionally, Singapore issues green bonds to finance environmentally sustainable projects, meeting the growing demand for socially responsible investments. Despite having a high debt-to-GDP ratio, Singapore rarely borrows to cover budget deficits, unlike most other countries where government bonds are issued to raise funds when government spending exceeds revenue from taxes and fees. Singapore's strategic focus on developing the local debt market and managing liquidity effectively not only maintains financial stability, but also ensures efficient management of the country's substantial foreign reserves. This approach to borrowing is instrumental in Singapore's ability to uphold its strong economic stability and foster consistent growth, factors that contribute significantly to its capacity to maintain low interest rates. The country's prudent fiscal policies, robust financial regulation, and strategic investments create a favorable economic environment that supports low borrowing costs. Singapore's high credit ratings, achieved through disciplined financial management and substantial reserves, also contribute to its low interest rates. High credit ratings signal to investors that lending to Singapore is a low-risk investment, which allows the country to borrow at lower interest rates. Singapore's success in managing its debt burden stems from its unwavering commitment to fiscal discipline, exemplified by the government's strategy of borrowing to invest through its sovereign wealth, such as Temasek Holdings and GIC Private Limited. This approach not only supports low interest rates, but also ensures that the returns from these global investments generally exceed the cost of borrowing, thereby enabling the government to keep interest rates low without compromising financial stability. Investing in infrastructure is paramount for Singapore's future growth and development, as these projects create jobs, boost productivity, and enhance citizens' quality of life. Through meticulous planning and risk assessment, Singapore ensures that its infrastructure investments contribute to sustainable economic growth. Despite the inherent risks, the nation's strategic approach to infrastructure investment proves beneficial in the long run. By carefully evaluating projects and implementing them in phases, Singapore minimizes risks while maximizing the benefits of its infrastructure investments. To sum it up, while Singapore's high debt-to-GDP ratio may raise concerns, it's important to consider the broader context. Singapore's debt is manageable due to its prudent management and strategic investments. The government's commitment to fiscal discipline is evident in its consistent maintenance of budget surpluses and efficient management of expenditures, ensuring stability and financial security for the long term. As a major financial hub, Singapore borrows money from banks and people from other countries. However, this borrowed money becomes part of Singapore's assets, adding to what the country owns. In addition, the money Singapore earns from these assets is more than what they pay back in loans, making Singapore a net creditor with more assets than liabilities. This financial strength is reflected in Singapore's strong credit ratings, solidifying its reputation as one of the safest investment destinations globally. When accounting for assets, Singapore's financial assets are well in excess of their debt. This challenges the notion that high debt levels are always detrimental and illustrates how debt can be a tool for sustainable growth when managed wisely. That's where we end our video. Thanks for watching.